Welcome to our next section, investment and retirement planning. Some things I may have already covered, but I'm covering them again just to keep them on the top of your mind. The first thing, saving and investing are not the same thing. Saving is the act of putting money aside. Investing is what you're doing. So see the difference again. Trading and investment are not the same thing. Trading is an activity performed in a short period of time to profit from market fluctuations. Long term is investing. It's a longer term view on your portfolio of assets aligned with your goals. And you make different decisions based on them and engage in different strategies to achieve the goals that you've set out for each one. Again, this figure here where you can clearly see stocks clearly outperform every other asset class over time. That's what you have right now. If you're 2021, you still have time on your side. Let's look at some of the planning issues surrounding the future. Statistically, you will live well into your 80s or 90s. It's a long time. The nature of work is changing, okay? All of us will have multiple careers over multiple companies. If I look back even on what I've done on my life, I've probably had 20 different jobs with multiple companies. Okay, and I'm still trying to figure out what am I going to do next. Okay, so we have this. You move from company to company, from job to job to company to company. I moved within HSBC numerous times to different roles, same company, but different roles as I continued to adapt and change. You're going to have to do the same thing. Second, people are easing into retirement. It's no longer you work your every single day, 9 to 5 or whatever you're working, and then you stop working. I think you tend to ease into retirement. I think I'm doing that right now, of easing into retirement. I used to easily work 50, 60 hours a week for years and years and years and years. And now I've still work. I work really hard, but I'm probably down to 40 hours a week now. But I also have flexibility. Okay, and that is important to me. So I'm easing into retirement. Will I ever retire? No, I'll always be doing something. It's just how much time. So that changes the nature of what this future looks like. We work honestly for both money and satisfaction. Money at times to get us special things that we want. I like to travel and go away for a long period of time, but also satisfaction from what I do. In many ways, work defines who we are, and that is important to us behaviorally and as individuals. So the first question is, how long do you want to work? Okay, there's no right or wrong answer, but remember, this easing out, taking time and backing off is part of it, but that's tempered by how long can you work. Okay, how long you want to and how you can. And that's an important thing because sometimes physical will get in the way. And then also my stamina to be able to do things. You know, when I'm 90 years old, will I be able to do what I'm doing today? Probably not. So that's how long you want to work. If you only want to work till you're 55, that's fine. 60, 65, 70, it doesn't matter. We just got to have a sense of what that date is, because how you approach it is going to be dependent on that. The second question is, when you're not working, how will your financial needs be met? To some degree, your lifestyle, anticipated lifestyle in retirement will define your needs. Okay? If you want to have places in Florida on a gated community, you want to have a $500,000 house there, you want to have something in the Northeast for when you come back for the summer, what are you going to do? Are you going to spend all of your time traveling? It doesn't matter, but you have to define your lifestyle. The second thing is, how much will you need? Now, this varies. 70 to 90% of your pre-retirement income. It's been a historical number. If you look at it, 80 to 90% is one to figure. Some costs will go down, but others may come back to replace them. In your earlier years of retirement, you will probably spend more than you will in your later years. But all depends on how you live. could be 100%. I'm not sure. I look at it now and say, well, could I really live on anything less than what I'm making now? I don't think so. So I got to start thinking about that a little bit more. I guess I could live at 90%. Where's the money going to come from in my retirement? In your retirement, where's money going to come from? Well, the first thing that comes to everybody's mind is Social Security. Okay, you pay into that. I've been paying into it way too long. If you have had part-time jobs or if you work, you've had Social Security and you've paid into it. The next category are pension payments from your 401k to your 403b, from IRAs, whether that be a Roth or a regular, and then other savings. Oh, did I forget to mention that I'm married rich and have tons of money, so I don't need to worry about this? No, just kidding. So what we're going to do now is walk through each one of these so that you understand what they are and how they work. The first thing is Social Security. Social Security was originally meant as a safety net, and people at that time only lived a few years after retiring, and that's not the case anymore, as we saw. So Social Security is based on your age, the number of years worked, and the income during those years. You need 40 credits, 10 years of work to qualify. And you have an annual statement. And if we go to Social Security government, you can find a lot of information. Let's keep going on Social Security. Let's just keep going on Social Security. There is retirement and disability. Okay, so if you become disabled, unable to work, and you get fully disabled, you can get a payment. Social Security has an annual cost of living, and for the average worker, okay, and that's probably somebody making about $45,000, $50,000. It provides about 40% of your average earnings before retirement. I've actually attached some Social Security booklets for you to look at that to understand more. They have something interesting here in Social Security called full retirement. Okay, and this is when you can collect 100% of your Social Security benefit. If you retire earlier, you can start to retire at age 62, but your benefit is reduced. In some cases, it's 25% lower than if you waited till full retirement. So you can see here, you guys all fall here, 1960 and later. You can't collect full Social Security until you're 67. Okay, but you could start at 62, but it's going to be lower. Now, you think that's great. Let's just take a quick look here at this. This is based on average benefits paid. A retired worker got $1,294 on average, and retired couple got $2,100. A lot of this averages that the people that are on Social Security today, the spouses didn't work. You had one, and spouses of those that are retired really didn't enter the workforce till later in life. So start thinking about that. $1,294, $2,111. Now, Social Security is part of a plan. Let's take a look at this quick Social Security calculator and estimate what your Social Security will be. This is the Social Security quick calculator. It's intended to give you a rough idea of what your Social Security payments would be. So let's just start off here, and I made the assumption that you were born in 1970, make $40,000 a year, and let's just see what you would get at that. Well, if it comes back that you were born 6/15/1970, $40,000 in today's dollars, if you retired at 62, you would get $998. 67 in 2037, you get $1,468. And if you waited even longer, delayed it, you would get $1,851. So you can see the difference between retiring at 62 and 67. So, but when you look at that, this is not something you're going to be able to really live on. If you become disabled, you would get about $1,290 a month. Again, that's not a lot. Let's go back And let's just assume 1988. Okay, and let's put in 50,000, and let's see what it would be. Okay, so you can see that in 2050, you'd be 62, you'd get 1276, 1812, 2247. So this gives you a sense of how to do these quick calculations. It's not exact, okay? So if we put in 1992, which should, if I do my math correctly, be close to you guys, this is what you would be getting. Okay, this is in current dollars, and at this point I think you got to start looking in current dollars and let inflation take care of itself for where we are. So what I'd like you to do now is, based on your financial plan that you've developed 5 years out, go back to have developed in application project 2 your plan for 5 years out and 1 year out. Put in the earnings that you hope to be making in 5 years. So if you put down $100,000, you would see your payment would go up to $1,813. But as you see, you're not getting as big an increase because there's limits. So I'd like you to try it now, and this is going to be the first step in application project 3 today. Is, will Social Security be there for me? I'm not worried. It's going to be there for me. The question is, will it be there for you? Well, let's put some facts up on the table. Social Security is not about to run out of money anytime soon. Recipients get money paid from payroll taxes and interest from the assets the trust has. So money keeps coming in. And the Social Security Trust Fund that pays the benefits, the government doesn't pay this out of operating expenses of the government. So that's something when you keep hearing the politicians' entitlement. Social Security isn't a retirement. You paid into it. You're not entitled to it. You've paid for it. Okay? And that's an important thing. In the most recent year, they had a surplus of $32 billion. They took in $855 billion, and they paid out $823 billion. There has been, over the past, every year since 1982, and that was the last time Congress revamped Social Security, revenue should continue exceeding costs until 2020. The trust fund would be completely depleted in 2033, but that simply means that there will be a shortfall between what the system collects and what it pays. So if you look at it, even if they do nothing to fix Social Security, which are a lot of things they can do, but that's another topic, they still will be able to pay out 75% of the benefits from incoming cash flow through 2088. So there'll be something there. But remember, it's the size, and you calculate it what yours are. You're not going to be able to live on that. So you're going to have to develop other approaches. What else can go into your retirement income? Pension. Right now, there's something called a defined benefit retirement plan. And this the employer sets up. They set up a trust, and they agree to pay you a fixed amount per year based on your years of service and income. Okay, so they might say, we'll give you 2% for every year you've worked there. The employer takes the risk with this to make sure there's enough money. It's separate from the corporation's, the employer's assets, but they have to fund it to be able to pay that. So they take the risk. Now, this is essentially in private industry is obsolete today. Most firms have eliminated that. One of the few places to still get a defined benefit pension plan is with governments. Okay, so those of you that would like to be police officers, corrections officers, teachers, and work for the government, you can still participate. New York State is actively encouraging you to move to a 401 or 403B. Now, a defined benefit retirement plan stays in the trust. You can't take it with you. So if you're with the company for a number of years and you move on, you can't take that asset with you. And there's many rules when you're eligible, how long you have to be there, and most of them have a reduction in benefit before age 62. So that's a defined benefit retirement plan. It's a dinosaur, okay? And governments being one of the few that are left like that. Next one is a 401k, 403b. Those titles come from the tax code which authorizes them. 401k is for private companies. 403b are for not-profit. Okay, 401ks are for profit. 403bs not. Essentially the same thing. They're known as a defined contribution plan. In both cases, they're established by an employer. There's a separate investment manager, a separate advisor. This is portable. You take it with you. So if you move from one company to the other, your 401k, 403b can move from either that to the next employer or to what's called a rollover IRA. We'll talk about IRAs in a minute. So it's portable. The employer selects the provider, and generally that is a large firm. You could use Vanguard, you can use Schwab, T. Rowe Price, etc., but that's the provider. In many cases, the employer actually makes a contribution on behalf of the employee. And oftentimes it's focused as a match, a set percent. We'll give you, if you save 5, we'll give you 2. So essentially you'd be saving 7%. So this is where the risk of managing the assets shift from the employer-sponsored trust to you as an individual to make a decision. Generally, it's paid in pre-tax dollars so that you can pay for it in pre-tax dollars. So that's before you pay federal and state income tax, so you can get more from that. And that, as I said, shifts the risks to employee. You have to make sure you have enough money put aside. These are workplace-based programs. Surprisingly, the number of people that fully participate is incredibly small. The other one we have is an individual retirement account, IRA. These have been around for a while. There's what's a traditional. They reduce your taxes. Remember, you have adjusted gross income. These are deductible from adjusted gross income. There are certain restrictions. You can't be covered by an employer plan. If you're covered by an employer plan, you can't take a deduction. If you can take a deduction because your employer doesn't have a plan, you contribute up to $5,500 if your adjusted gross income is less than 60, if you're single, 96 if married. You can contribute to a non-working spouse. Earnings grow tax-free over the life. This is where compounding comes back in. Withdrawals are taxable because you put it in pre-tax, you didn't pay any tax on the earnings, so when you take it out, it's taxable. Now, hopefully in retirement, you're in a lower tax bracket. Withdrawals are, if you do it before you're 59 and a half, you have a penalty, a 10% penalty. So it's really an intent is to keep it there for retirement. There are certain exceptions for catastrophic medical expenses, but that's a traditional, okay, deductible. You can also do a non-deductible one, and that's open to anyone regardless of income level or covered at work. You just can't get a deduction. So you're funding it in after-tax dollars. Earnings, though, accrue tax-free until withdrawn. You have to keep records to make sure that your basis in this IRA are properly identified. And you know when you take it out, a portion of it will be taxable, the earnings, and the non-taxable contributions you make aren't taxable. But if you've used the mix of them, depending on what your employment is, you really have to keep good records. Again, a penalty of 10% before 59 and a half. Then there's a Roth IRA. Contributions up to $5,500. They're not deductible when you make them. They're after-tax dollars. Your AGI has to be less than $183,000 if you're married, $116,000 if you're single. You're eligible regardless of employer retirement plan, so you can be covered or not covered. Earnings accumulate tax-free, and if the account is open for 5 years and the person is 59 and a half, withdrawals are not taxable. Okay, just becomes an important concept here because if you have it for 5 years and you earn money, as we saw that in our last model, you can really see that that could be a very positive tax benefit to you. If you have $100,000 of earnings and you don't have to pay taxes on that, that's the same as getting about $60,000 in taxable earnings. So it can be a big number. And for those of you that are just starting out, a Roth IRA, unless you are not covered, can be the best thing you can do after your 401k, 403b. What do you need to retire? It depends. Okay, it's based on income and what you live. You can click here to get a model, which we'll come back to in a moment. But let's start with something very simple. Desired income per year. Let's say I want to have $72,000 a year, $6,000. I figured my Social Security, as we just saw, at $20,400 or $1,700. So I have a gap or a shortfall of $51,600, $4,300 a month. Now everybody here has done your budget. Okay, so now the question is, can you live on $1,700? Why don't you just go check that for a moment and see what it is. It's so essential. My retirement funds need to spin off enough income to provide for that. So if you look at it, there's a number thrown around that you've got to make a lot of assumptions. But a simple way would say, I need $1 million or so to recover. Okay? Because if you took 5% out a year, that would give you $50,000. But it's based on a number of factors. The time you have to retirement, the savings rate, how much you're putting aside, what's your risk profile, and then what your rate of return is on those assets. That's where we're going to get into asset mix, and they account for the majority of investment returns. Let's take a look at what has the average American saved. And this comes from Vanguard, How American Saves. Under 25, $3,865. Well, hopefully all of you, when you've done with your budget, have more than that. Okay? But look at this. When you get up here, there's not a lot of savings. So remember that gap of $51,000? That's going to go pretty fast. If you use that, that's only going to give you 5 years. So this is sort of like, this is scary because it's going to change the nature of America. But you got to look at this now. You're taking this class in summer 2015, and you're ready to go. But how are you going to live in retirement? What happens if you don't have enough money in retirement? Well, you're going to have to adjust your lifestyle. In the long hand, you'll see some of these here. I'm just going to let you look at them for a second. Do you want that? Or do you want to make the best of your life? Okay? Lifestyle planning, you need to have a plan. What should you do? First is start saving early. Contribute. Meet your employer match. Consider mutual funds and ETFs that invest in stocks. We're going to talk about that as we go forward. Don't cash out when changing jobs. If you change a job, don't take that money and spend it. Roll it over. But this is a thing that shows you the power of compounding. When you have the growth and investment, it really can make a huge difference between $1 million and $2 million. So let's start the plan. A couple of steps. Determine your risk profile. Develop a broad allocation. Determine a broad allocation strategy. Develop a detailed implementation strategy. And implement the plan. Monitor. And revise as appropriate. So these are the steps. We're going to start right now with determining your risk profile. Individuals have a risk tolerance. You need to be able to sleep at night and be comfortable with your investments. People underestimate risk when the markets are doing very well and overestimate it when it's a bust. Okay? You got to look at what's going to happen and be comfortable with it. So you should think seriously about how much you could watch your savings drop before you panic. There's models to determine risk and then asset allocation. Let's take a look now at what model is best for me. This is a very basic investment questionnaire that's provided by Vanguard. And what the intent is to get a sense of what your risk tolerance is. You're going to ask a series of questions. We will respond, and then it will tell you a desired mix of your portfolio. So I'm going to accept. Click right there. So the first question is, when are you going to be using the money? This takes into account the time framework. So for me, I'm going to put in for the next 11 to 15 years. Okay, so I have a longer term. You're probably going to be more than 50, but it's up to you. As I withdraw money from these investments, I plan to spend it over a period of what? Okay, then I got to say 15 years because I sure as hell hope I'm going to live that long. I plan to keep it invested. I'm not going to back out 8 years. Now, let's look at this. The question then becomes, from September 2008 to November 2008, stocks lost over 31%. Okay, if I owned an investment about 31%, what would, in 3 months, what would I do? Would you sell? Would you sell a portion of it? Would you hold on and sell nothing, or buy more? So this is where you sort of got to say, how would I feel? Now, I will tell you, during that same period, you know what I did? I just held on. Okay. Next, I prefer investments with little or no fluctuation in value and willing to accept the lower return. No, I strongly disagree with that, mainly because I've been through a lot and I believe that chart. But you don't have to, so I say strongly disagree. During market declines, I tend to sell my riskier assets and invest in safer assets. Disagree. I tend to buy. But it's up to you. I would invest in a mutual fund based solely on a brief conversation. Of course not. Strongly disagree, because I got to do some research, and that's what hopefully you're going to learn from here. Bonds lost nearly 4%. If I owned a bond investment that lost 4%, what would I do? Well, did the same thing. This is a next question, and this is interesting. The chart below shows the greatest 1 year and the highest 1 year gain on 3 hypothetical investments of $10,000. So this is a matter of how you're going to balance the risk. And I'm going to go pick, I'm probably medium volatility. My current and future income sources are stable. When it comes to investing in stocks, I would describe myself as, you describe yourself, experience. What are your current asset allocations? For you, I'm going to put in, you should put in 100% short-term reserves. For me, today, I'm 5, 20, and 75. So you're going to put in 100 here. But if you do have some money set aside, put whatever mix it is today. So let's see what the results are. Okay, so what it's actually saying is I should put, this is my current allocation, and this is suggested is 80% stocks, 20% bonds, none in cash. Okay, so how do they arrive at that? So this is what they're suggesting I do. You're going to have your mix. Let's see how it was they arrived at it. It's based on risk tolerance, your financial situation, and it takes into account some investment theories that account for the historic returns. So this will give us our basic allocation model. So what I'd like you to do now, is to complete this and determine what your suggested allocation is. This is going to be your broad allocation, and we're going to use that. We're going to use this application project. We're going to move on to the next section, developing a detailed implementation strategy. And as always, please let me know if you have any questions.